Hey everyone, and welcome to This Explainer. Today we're going to climb the ladder of capital together. If you've ever found yourself wondering how businesses actually pay for their own massive growth, scaling up from that very first dollar sitting in a basic savings account all the way to securing complex multi-million-dollar institutional investments, well, you are in exactly the right place. I absolutely love unpacking these structures because honestly, once you see how capital flows, you truly understand how businesses survive and thrive. We're going to visualize every single step of this journey today, so get ready to focus in.
All right, here's our roadmap for today. 1. Basics of business funding. 2. The pecking order theory. 3. Filling the capital gap. And 4. Measuring mezzanine capital.
Okay, let's dive right into Section 1, Basics of Business Funding, Tools for Entrepreneurs.
To really get this, I want you to put yourselves in the shoes of two entrepreneurs, John and Kelly. They have this huge dream of opening an auto repair shop, but of course, they need cash to start. This is a classic funding journey. Step 1, they calculate their costs and dip into their own savings. But they hit a wall pretty fast and find themselves 60% short of their goal. So moving to Step 2, they pitch to investment firms. One venture capital firm actually agrees to cover 20% of their goal, but in exchange for part ownership. For Step 3, they go straight to their local community with a crowdfunding campaign, securing another 10% from excited future customers. Okay, but they're still 30% short, and traditional banks think they're way too risky. Finally, Step 4, they use the SBA's Lender Match tool to find a lender willing to offer a guaranteed loan to cover that last 30%. Step by step, they piece together their capital structure.
Let's actually zoom in on that very first step, self-funding, which you'll often hear called bootstrapping. This is the bottom rung of the funding ladder. The absolute beauty here is that you retain 100% control over your business. Nobody is telling you how to run your auto shop. But the flip side, you take on literally all the risk yourself. You have to be incredibly careful here. For example, if you choose to tap into your retirement accounts early, like a 401k, you might face some seriously harsh penalties. And let's face it, the IRS isn't exactly known for being forgiving, so it's a high-stakes first step.
Now, when John and Kelly had to look outside their own bank accounts, they used two vastly different external tools. On one hand, you've got venture capital. VCs focus on high growth potential and take on big risks, but they almost always want equity, actual ownership, and a seat on your board of directors in return. On the other hand, crowdfunding raises small chunks of money from a massive crowd of people. The beauty of this is that crowdfunders don't want equity at all. They just want a perk, a little gift, or maybe early access to your product. So ask yourself, if you were John or Kelly, would you be willing to give up a board seat and partial control of your dream just to get the cash you need?
That instinct right there to protect your ownership leads us directly into Section 2, the pecking order theory, a financing hierarchy.
This brings us to a really fascinating concept, deeply researched by economists over the decades. The pecking order theory is a financing hierarchy where companies prioritize internal financing first, things like their own profits or personal savings. They only turn to external financing, like bank loans or outside investors, when those internal funds are totally tapped out. Think about it. This perfectly mirrors John and Kelly's instinct. They only went out to VCs and banks when their own savings ran dry.
And this brilliantly illustrates the whole setup. Corporate financing is broadly divided into two paths. First, internal financing. This is the go-to, the first choice in the pecking order. We're talking retained profits, reserves, or even selling off assets. But when a company exhausts all of that, they have to move over to external financing. Now they've got a tough choice. Do they give up ownership through own capital, like issuing new shares, or do they take on debt, like bank loans? It's a constant, everyday balancing act between internal safety and external growth.
But what happens when a business has a super successful, established model? They've tapped out their internal funds, but traditional debt and equity simply aren't enough to reach the next rung of the ladder? Well, that brings us to Section 3, filling the capital gap, the middle ground.
Enter mezzanine capital. This is literally the ultimate hybrid financing instrument that steps in to supplement that frustrating enterprise capital gap. Imagine a mid-sized company that wants to do a massive merger, right? But they don't have enough physical real estate or hard collateral to secure a traditional bank loan of that size. Mezzanine capital provides the exact solution. It beautifully combines characteristics of both equity and debt, creating a super flexible lifeline for businesses that are ready to scale up but find themselves completely stuck in the middle.
So, you're probably wondering exactly how expensive is this? Well, to put it in perspective, a traditional, secured bank loan is relatively cheap for a company, costing an expected 5 to 12% return.
On the total opposite extreme, bringing in pure own capital, meaning giving up equity to investors, is incredibly expensive. That usually requires a 25% or more expected rate of return. Mezzanine capital sits perfectly right there in the middle, demanding a 13 to 25% return. It bridges the gap flawlessly in terms of both cost and structure.
Now, what's really interesting about this is how it perfectly summarizes its hybrid nature. External financing generally flows into two distinct streams: own capital and foreign capital, which is essentially just debt. Mezzanine capital is the unique intersection of the two. Because of this really specialized position, the cost of mezzanine capital sometimes includes not just your typical interest payments, but actual participation in the company's equity if certain growth targets are hit. It truly is the crossing point of debt and ownership.
So how do we actually measure a company's success after securing this kind of complex financing? Let's move into Section 4, Measuring Mezzanine, Post-Financing Success.
Researchers who study these European markets use a highly complex mathematical formula to figure this out. But don't worry, we're going to totally bypass the dense academic math today. Instead, let's just focus on the ingredients that go into their formula, which they call the aggregate index, or AI. To get this one clear score of business health, they basically combine four things. First, profitability, which looks at returns on equity and assets. Second, financial liquidity. Basically, can the company pay its short-term bills? Third is the total debt ratio. And fourth, turnover ratios, which measure how fast they clear inventory and collect cash. By rolling all of this into one single number, the aggregate index gives us a crystal clear picture of a company's economic efficiency.
Let's see this index in action over a 10-year span for a company called Solaris Bus & Coach. The exact moment they receive their hybrid financing actually triggers an initial dip in their economic efficiency. Taking on that complex capital is a really heavy burden at first. But within a couple of years, the index stabilizes and then shows a pretty remarkable recovery and growth phase as the company successfully deploys that new capital. Let's move to another example and see how this builds. For a company named Kisan Insects, right after the injection of mezzanine capital, their index dynamically shoots upward. It absolutely proves that when it's deployed correctly, injecting mezzanine capital can create a dynamic, multi-year surge in business efficiency and profitability, elevating the entire company to a totally new level of performance before things eventually normalize. So what does this all mean for us? The crucial point is this: the money you use to build a business isn't just cash, it's a structural foundation. From John and Kelly bootstrapping their auto shop with personal savings, naturally following that pecking order theory, all the way up to massive enterprises utilizing hybrid mezzanine capital to bridge multi-million-dollar gaps, every single choice carries a distinct blend of risk, control, and expected return. So I leave you with this provocative thought to consider today. What does your capital structure say about your business's future? Are you built for control, or are you structured for dynamic growth? Thank you so much for joining me on this explainer, and I hope this deep dive has helped you master the true ladder of capital.